IVM.
On this episode of Paisa Vaisa, we are doing an F&O trading special with Kirit Manral, who is a professional trader. In the first part, we are going to talk about F&O basics. So stay tuned for that.
Hey everybody, it's another awesome week on IVM Podcast. If you're not following us on social media, please make sure you do. We're IVM Podcast on Twitter, Facebook, and Instagram. This week on Cyrus Says, Cyrus talks to journalist Rachel Lopez about her taxi stealing art series and her own podcast, Wordy Wordpecker, available only on the IVM network. On Simplified, Chuck, Naren, and Shrika deconstruct the latest UN report on climate change and why the next 2 decades might be the most important for the Earth. On the latest special episode of Paisa Vaisa, Anupam talks to Hansi Malhotra, an investment professional and owner of the financial blog, themoneyhunts.com. On Shunya One, Sheila Ditya and I speak to Arpit Ratan, co-founder of SignZ, a fintech company that makes regulatory processes for bank and other financial institutions simple, secure, and compliant. On the Kinetic Living podcast, Coach Urmi talks to childhood buddy and actor Shikat Alsaniab. She elaborates on her fitness journey and how she balances work, diet, and the need to stay fit. And just a reminder, guys, please tell a friend. You need to tell a friend that you're listening to a podcast that you like and get them to listen to the podcast that you think they will like. And with that, let's take you on with your show.
Folks, welcome to Paisa Vaisa. I'm your host, Anupam Gupta, B50 on Twitter. And this is going to be a stock trading special, okay? And an F&O trading special. Now, before I introduce my guest, I just want to spend a few minutes on this entire concept of investing versus trading, right? Because a lot of us all of us know what investing is. This entire campaign that AMFI has done over the last few years has improved our understanding about mutual funds and about stocks. And as per AMFI's own data, in fact, there are about 2.5 crore SIP accounts which are putting in almost $1 billion every month into the stock market. So that's a big amount. And the entire thesis, the entire philosophy for that is you invest for the longer term. Why? Because when you invest over the longer term, you reduce your chances of losing money, okay? Because nobody knows where the market goes for 1 year, 2 years, 3 years. No one even knows what happens in the market every day. You come in at 9 o'clock and you can't even predict what's going to happen at 3:30. But there is something called stock trading. And it's exactly about what happens in the market from 9 to 3:30. And I know that a lot of people probably look upon it as something as gambling, something as speculation and all. Well, I won't get into the ethics and all that, but the fact is that trading is globally a very well-known fact. Okay, there are a lot of people from George Soros to Paul Tudor who are spectacular traders, and their calls on the market and a lot of their stuff has actually made them a lot of money. It's not easy, by the way. It requires a lot of discipline. And to explain all of that, I'm having this F&O trading special to explain how this entire thing works. Okay, and we're going to keep this really basic. Okay, we're going to have 2 parts in this show. In the first part, we're going to talk about the basics of F&O. By the way, F&O stands for futures and options. Okay, all of us are very familiar with mutual fund units and shares and buying shares, selling shares, buying mutual fund, selling mutual fund. But an F&O is a derivative. Okay, we're going to get into the details of all that. And for that, I'm going to introduce my guest, Kirit Manral. My God, what a fascinating background he's got. The guy is a national level swimming champion. Kirit, welcome to the show. Introduce yourself, man. Seriously, I want to do a separate podcast with you on swimming, like we were sitting and talking about freestyle, breaststroke, backstroke. My God. The one thing that I want to know, okay, does competitive level swimming help you to become a better trader? Let's start with that and then tell us about your background.
Firstly, let me thank you for inviting me on the show.
Sure.
That's a good question. It does make a big difference. If you actually look at any sport where you excel at the state level or the national level, what are the key takeaways? A is discipline. So the same goes with trading. If you want to be a successful trader, you need to be well disciplined. B is the mental strength. As in, whenever you are in a game, I always keep telling younger swimmers currently, it's 60% is what you put in efforts, 40% is the mental game. I'll just give you a classic example. When we used to go for nationals and in the finals, so in nationals you have this way, you have 2 swimmers from every state, the fastest 2 swimmers. They all swim the heats and the fastest 8 timing will make it to the finals. Now certain states, without naming them, so let's say in a race, if his best timing was 30 seconds and he knew that you are faster than him, So he'll come up to you just before the race is about to start, and he said, 2 days back in practice session, I've done a 27.
Oh, psyching you or something,
Yes.
huh? Okay.
And that's where I have seen even the good swimmers, they get nervous and they've ended up losing. Another classic case I'll give you, the fastest runner was Paisa Vaisa before Usain Bolt. Now, Justin Gatlin was very good at playing mental games. So if you read the biography of Usain Bolt, there is one particular instance of the World Championship wherein he knew that, Justin Gatlin knew that Paisa Vaisa is in superb form, in the heats, and it's going to be a tough bet for me. And the first thing Justin Gatlin does is, he goes to his lane, he looks at Paisa Vaisa and he spits on the lane.
Oh my God. Okay.
And Usain Bolt is a watcher. He's standing aside. And in that book, he has mentioned, and I knew Paisa Vaisa had lost the race.
Then and there.
Yeah, because the expression when Justin Gatlin did that, Paisa Vaisa was actually looking into his eyes.
My God.
And his expression said it all.
Yeah.
And eventually, he ended up losing the race.
Wow.
So you need that mental strength. You need to be strong at 60% the effort that you put in, and 40% is the mental output. Now, these two ingredients are very important in order to become a successful trader. So
That's a fantastic takeaway here. Lots of similarities between competitive sports and the mental strength and discipline and training that you need. Those are the real essentials to even have a great strategy in trading. Let's for our listeners, let's just get down to complete basics, okay?
Okay.
Let's just explain what exactly is a future and what exactly is an option. Let's just start this. Maybe spend just 2 minutes on that, and then we'll go forward from there.
No problem. A future is basically a contract, which expires on last Thursday of every month, and the lot size of the particular future is fixed by the exchanges. Now, for example, you can trade in Nifty, the index, which comprises of 50 stocks, where the minimum one lot is 75 shares. Now the same goes with option, wherein you pay a premium, and that option expires again on the last Thursday of every month. Now in case of option, let's say if you buy a stock which is trading at 100, and your study says that probably in the next 20 trading days or 20 calendar days, the stock would go to 110. So you buy an option of 105 or 110, you pay whatever is the premium prevailing at that point of time. The moment it crosses that rate, so you start earning profit on that. So these are basically two derivative instruments which have been introduced by the exchanges. And one major advantage is the current F&O list comprises of 214 stocks. And the only big advantage, according to me, is in case of shorting the market, which is very difficult for a small-time investor or a small-time trader, unlike which an institution can do it with great ease. So he has the option of shorting the stocks. So wherein he has to go to F&O. Either, short in the futures or buy a put call, which is basically you're betting on the stock or the index going down. Call is something you're betting on going up. It's bullish, and put is bearish.
Okay. So, let me put it this way, that someone who is generally positive on the Nifty would typically buy, say, a Nifty index fund or a Nifty, or do an SIP in a Nifty index fund or an ETF, which is fine. Maybe he's investing for the long term. Now, when I want to do the same thing for, say, 1 month, like you said, the expiry of the future or even the options is for a month, ending every Thursday, the last Thursday of the month.
And it today. Can be rolled over.
Yeah, like today.
Tomorrow.
Like tomorrow. Sorry, today's a Wednesday. So that means that 75 shares multiply by the value of the Nifty, which let's say is 10,000 today.
Correct.
It's about 10,200, but let's just say it's 10,000. So the contract value, so to say, is 75 multiplied by 10,000.
Correct.
But I'm not paying the full amount. Right?
You're not paying the full amount.
Exactly.
There is a margin which is prescribed by the exchanges. So there's a span margin, and then there's an additional margin to safeguard exchanges. So roughly, which keeps varying from brokers to brokers. So roughly, if I were to buy or sell one contract or 75 shares of Nifty, I would need somewhere between 50 to 70,000 as margin.
Correct.
Once that margin is there with the broker, it's only after that the trade can be executed.
Right.
Going forward, if the trade is in profit, the mark to mark, which is called as M2M, profit, gets credited. If it's in loss, you have to keep paying that MTM margin.
Right. So, let's just take a theoretical example that today, or let's say whenever the new contract starts, on the first day of that, let's say the coming Friday,
Okay.
I actually think that the Nifty is going to go up.
Okay.
By the end of November.
Okay.
So I'll buy one lot of Nifty futures, okay, at whatever, 50,000 you say. So I call up my broker and say, मेरे को एक lot Nifty का खरीदने का है futures का. Boom, that's it. So now it's with me. Now the race begins. Each and every day as the Nifty goes up and down, my account keeps on getting debited or credited.
Correct.
Am I right in that?
Very much.
So the main thing, okay, listeners, this is for you to understand. You need a basic starting capital in your bank account for your broker to debit. Okay. And now as and when the Nifty goes up and down, your bank account will keep on going up, keep on going down with the profits or losses. This is called mark to market, right? Let's say that the Nifty goes up by 200 points. You'll get whatever, 200 into 75 into your account. Let's say that the Nifty actually falls to 9,000 or 9,500 because, that's a very big amount. You actually need to have that much money in your bank account to pay the broker. Okay, so this is how a future works. Am I right, Kirit?
Absolutely, 100%. In case if there is a shortfall of margin, the broker will call you up, and in case of non-compliance, he is free to square off the position, which happens currently, most of the cases. So that's the reason, when you have big gap downs, because perennially I've seen over 90%, be it trader, investor, or the entire universe, whoever is in the stock market, they are perennially bullish.
Oh, I didn't know that. Okay,
yes,
interesting.
Perennially bullish.
Okay.
So in such cases, usually you see if there's a 300-point gap down, so you will have a selling spree which happens at 940.
Oh.
Okay. Or a 1015 or 1130. It depends. So the first selling spree which happens, having been actually glued to the screen for all these donkey years.
Yeah.
So we know it is those with the margin calls have been triggered.
Right. Okay. And so that explains the future. Okay, that's one type of derivative. Correct. Now we'll come to a call and put. Okay, which is called an option.
Very true.
Now a call is a derivative which you buy if you think the market is going to go up.
Very true.
Now these calls are priced at a certain amount. Okay, and therefore a certain time. You can buy, for example, a call which is due in after 1 year. At a certain price. Okay, let's just say that you think in the next 1 year the Nifty is going to go up to say 11,000. You will find in the exchange a call option for 11,000 that matures in November of 2019. Okay, probably going to trade for whatever. Let's just say it trades for 100 rupees. Okay.
It will be much more because they are factoring in the time.
The time option. Yeah. So it's 100, it's 120, whatever it is. So then you call up a broker and say, "मेरे को एक lot 11,000 Nifty call option for November 2019 खरीद के दो."
Absolutely.
Okay, and you have to pay the amount out there. Okay, now there's no mark to market out here.
No.
What happens out here is that you actually sell that or you square it off at some point of time, right? How does that work?
So let's say if I bought the November 2019 11,000 call at 150, okay? So it's 150 multiplied by 75, which is roughly 22,500 plus the brokerage that is debited from
straight away
account.
to my account. Yeah.
Now let's say if you feel, any time from the time you bought up to November 2019, let's say if it goes to 200 or if it comes to 80, you can sell it off and whatever is the difference, that gets credited to your account.
So that is the amount of money, or that is how trading on a call works, okay? That you buy it at 200 and you sell it at 220 or 230 or whatever, assuming that your bet is right, okay? Because remember that this is not an SIP, okay, where you just keep on putting money for 5, 10 years. You have to track the Nifty almost every day. And let's say the Nifty actually goes to 11,000 by Jan, who knows? And your call doubles in value. Okay. You might want to say, okay, I just want to sell this and get out. That's how trading works. Okay. That is called a call option. A put option is just the opposite, right, Kirit?
It's exactly the opposite. But here you have another option. Okay. Now this is a very simple route of, I feel Nifty will go to 11,000, 12,000, so I buy. Or if I feel Nifty can go to 8,000, so I buy a put. But you have an option of selling calls and selling put.
Which is the same, which is, so instead of buying a put, you sell a call if you think the Nifty is going to go down.
Yeah.
Right? Same thing.
Correct.
But there's a difference.
In that case, what happens is, let's say, if you feel by November 2019, Nifty will never go to 11,000. Okay. And the premium is 100 rupees. So when I sell, Okay, I need to pay the margin of one lot of Nifty, which may be between 50 and 70. But the amount, what I have sold of 22,500 gets credited to my account. Now, when you sell either a call or a put, your profit is fixed, but loss is unlimited.
Okay. Let me just repeat that for you guys. The loss is unlimited. That's essentially how F&O works.
And I can, if you permit, I can
Please,
give you
please.
one or two examples, I think, because,
Go ahead.
a lot of new traders will be. I have seen currently in the past year and a half that, let's put it straight, till last year the markets were very easy. It was very easy to make money. Okay, It's only this year that the entire drama started unfolding, and every day there is a new story.
2017 was just one line straight up.
Yeah, it was a straight up.
You couldn't go wrong.
You just couldn't go. It was just you had to buy and have the patience to hold.
Hold, correct.
And you made money. Okay. Now people were selling calls and puts. Okay. Now the amount is definitely much lesser in terms of premium, but the risk is huge. History, you need to look at history, and I'm sure if one has heard about Victor Niederhofer, just to give you a small example, he was 4 times world's cost champion.
4 times world cost. There is some linkage between sports and trading out here, right?
No, this is very interesting. The reason why I've raised this particular
Victor
topic.
Niederhofer is a legend, right?
He is a legend.
And
mind
saying
you,
the guy is 4 times cost champion.
yes,
I
he
didn't
has
know about
beaten
that. Okay.
Jahangir Khan,
Oh.
and he was awarded 3 times in a year.
Okay.
3 times in a row. The best hedge fund manager of the world.
Wow. Okay, go on.
And his specialty was selling options. And the kind of return that he had generated for his client. In fact, there was a time when George Soros invested his money in his fund, in Victor Niederhofer's fund.
George Soros himself.
Himself.
The man who broke the pound in
Yes,
1992
who
and made
broke
$1
the back
billion.
of Bank of England. Yes.
Okay, yeah.
And then there is this, instance that once Mr. Soros went to his house and he saw a painting, and it was some painting, and he asked Mr. Niederhofer. When Mr. Niederhofer described that painting, there was something which alerted George Soros that probably, this man is not the same what he used to be. He withdrew his fund. Now, coming back to Mr. Niederhofer, 1997-98, I think the
Asian financial crisis?
Asian financial crisis.
Yes, of course, yeah.
He went kaput.
Massive move. You could not predict that.
He lost everything because he had sold out of the money calls, out of the money put. Now, just a word of caution, I am not dissuading anybody from selling calls or put, because I know on Twitter they'll make my life miserable.
That's okay.
It's my job to tell you what is there in store. And then he lost everything. Okay, back to zero. And this didn't stop there. Again, he started his own fund. 3 times he's gone bust.
Wow.
Okay, his specialty was only selling options. And not to forget, LTCM. That's a classic case.
Long-term capital management, which was headed by Julian Anderson, and they had an entire league of people who were Ivy League and this very, very, very qualified.
Merton got a Nobel Prize.
Nobel Prize,
developed the Scholes model.
Yeah, of course.
Okay, the one which is being followed blindly by people.
The person who actually made the option pricing model.
Exactly.
He himself was part of LTCM.
And we all know who bailed out LTCM. Okay, it was at the last minute the US government felt as usual कि नहीं करेंगे तो हम सब बर्बाद होना है इसमें.
Yeah, okay.
So, on the face of it, it sounds very easy. You may make money 13 months in a row. But be cautious. 1 month takes away what you've earned in 6 years. I have seen many live examples. Even the recent fall which has happened, nobody knew. Because see, I mean, it's not about predicting. Nobody knows where the market will go.
Right.
You have a gap down 300 points open. You have sold something at 40 rupees.
Right.
It's quoting at 400.
Yeah.
I've been trapped. Even I do sell options, but on a very selective basis. So the only word of caution is whatever suits you. But back of the mind, see, when you buy a call or a put, okay, your loss is fixed. That's exactly the reverse when you sell. Another classic case of somebody who's been, because people usually say, and it is a fact that 90% of the time they expire worthless when you buy.
Correct.
Okay. But there are cases who make money, and the man behind the black swan theory, Nassim Nicholas Taleb.
Yes, of course.
Okay. His empirical capital only buys option.
He believes in a tail risk event, saying that one fine day there'll be a nuclear blast somewhere or the other,
And he
और
makes
मेरा
his money.
वहाँ मेरा पैसा बनेगा. Okay,
And
so
he's been making decent amount of money.
yeah. Okay, folks, let me just decipher that for you. Okay, what Kirit said about Talib is that Talib believes that there is, the entire concept of a black swan is that you see white swans everywhere. And then one fine day you see a black swan. What are the chances of that? So he's betting that one black swan event, like the global financial crisis in 2008, will happen, and you prepare for that. Okay, and once you do prepare for that, you're actually waiting for that. You make tons and tons of money. And when that event does not happen, you probably just end up paying the premium on that option, which
And
goes
that is
in.
calculated
That's fine.
well in advance, which I'll share with you how it is done.
Yeah. Okay. So I'm just going to recap on that, folks. We discussed a future, we discussed a call, and we discussed an option at a very basic level on how to execute it. Okay. Now there is a lot of exotic stuff out here that I'm deliberately not going to, because that gets too technical. Stuff like in the money, out of the money, stuff like butterflies, triangle, straddle. I would really recommend that you could go to YouTube, check out some videos on that to learn more about that, because that's a little bit more technical. I want to get into the basics out here, and more importantly, some of the psychological stuff out there and how to prepare for it. Okay, so Kirit, let's move on to that.
Okay.
Last two questions on this first part is that what is the kind of hard work that I need to do? What is the kind of effort? What is the kind of discipline? What is the kind of time requirement that I need to do if I want to start trading? Okay. And before that, if you can tell us the psychology. Okay. Because right now, all of us, me included, are only geared up for this SIP thing or for investing. Okay. We've just got a vague idea that market mein paisa dalte raho, market girega to aur dalo, and you just wait for 5 years, 10 years, whatever it is. A trading mentality is totally different. Okay. So I want you to tell me two things. One is the psychological makeup. And second is the kind of time commitment and investment required to become a trader. Tell me.
Okay. Now, the answer will be slightly lengthy.
Please, yeah.
Okay.
Sure.
But I will make it as simple as possible. See, whenever you start any new business, it takes a certain amount of time. Okay. And many a times you can be lucky and it takes off. And then when you hit the plateau, you realize, ab kya kare? Yeah. So what is essential is knowing about the business. When it comes to trading, here the markets are very smart. You initially start off, and majority of cases I've seen, they start making money right from the word go. And then one fine day, everything is gone. So what exactly you need to be to start in trading is, you need to know the topic about trading. And how do you know? So you require a lot of reading work to be done. You need to understand what is trading all about. In simple terms, unlike an investor who would buy, let's say, a stock at 100 rupees, his time horizon is infinity. He'll wait for 10 years, 15 years. And if the stock goes up 100x, 200x, so theek hai, whenever he wants to sell. Yeah. Trading is all about capitalizing the short-term swings in the market from point A to B. If the stock goes from 100 to 120, retraces back to 110, so you are trying to capitalize those smaller moves depending on your time frame. Now, this business is definitely not easy, because it has taken me to become a successful trader more than 6 years. I'm being honest.
That's it. Just 6 years.
Just 6 years, and I'm about to tell you what has happened in those 6 years.
Oh,
yeah.
The most
so
interesting
you
part,
need to endure those 6 years.
Yeah. Okay.
And I know traders on an average take 6 to 8 years. A is you need to understand what it's all about. Okay, what you need to know. What is the strategy that needs to be deployed? Okay, is there a holy grail or not? And the most important is the money management. So how does this happen? You need to do a lot of reading. You need to know history about trading. You need to know who are the top traders of the world. Now, one may ask question, how does it help me? Why do I need to know? But you definitely need to know, because you have to know the route map that they have gone through. Because you eventually going forward, if you stay in this business, will have to go through the same route map. Now, we've had traders like Richard Dennis, who was a classic case. I'm sure most of the guys must have known. He was a commodity trader who started with $1,200 and he's turned it into $500 million in span of less than 10 years. And mind you, Anupam, in fact, at one point of time, George Soros wanted to partner. He's one of the most opportunistic guys, Mr. Soros.
Which is a good thing, actually. Being a trader, you should be opportunistic.
So he wanted to partner with Richard Dennis. And what was Richard Dennis' strategy? He executed a very simple strategy, which was whenever the price goes above a 20-day high, I'm sure you can understand what a 20-day high is. You take prices of 20 days.
Yeah, and the highest point of 20 days. Yeah, that's fine.
Whatever the highest point of 20 days. Once it crosses, you buy.
That's simple.
Hear me out.
Okay.
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 That is the formula for going long.
Okay.
Okay. And the reverse for short. Whenever it crosses 20-day low, you go short. The stop loss is the low of 10-day in case of long. Okay. And the reverse in case of short.
Okay.
He went on to become the greatest trader, much better than Paul Tudor Jones.
Wow. Okay.
So it's actually that simple.
It sounds simple.
It sounds simple.
But it's got a lot of discipline in it. A lot of conviction.
But the problem will be if Mr. Anupam Gupta tries that same stuff tomorrow and he has 7 losing trades in a row. The first statement will like, Kirit Manral doesn't know anything. Yeah, he just...
Yeah, I've done this actually, folks. 3-4 years ago, I thought I was so smart that I'll trade the Infosys quarterly result. Hey, kya hai Infosys result ka? Pata hai it's going to be negative surprise. So you just buy a lot of puts on that day, or you hear the market and you say ki acha result aane wala hai. So you either go long on the future, you buy some futures, or you buy a call option, and then the gap down में ही पूरा निकल जाता है आदमी का यार. Okay, anyway, that's getting a little bit too technical.
Yeah.
So that takes care of the hard work that's required, a lot of reading. Okay.
You need to do a lot of reading. You need to come up with a strategy. Okay. Now, when I say strategy, in trading, you have different types of trader. One is the intraday trader who starts at 9:15. Whatever positions are there are closed by before 3:15 or by 3:15, whatever it may be. He will never ever carry any positions overnight. The second category of trader is slightly a BTST, which is buy today, sell tomorrow, or a positional kind. Somebody who would hold on, let's say for 2 days, 5 days, if the trade goes in his favor. And the third category is where I come in. We are long-term trend followers. Okay. So once I'm in a trade, the stop loss is decided, and we let the trade run. So you have to identify. Just because I'm going to share some formulas with you that this is what works with actual back testing, and you go and try. But you have to identify what suits your personality.
That's very important.
It's the most important point. That's where majority of the traders go wrong.
But that's psychology.
That's psychology, yeah. So if somebody is showing off his P&L statement every day and you try to tailcode the same thing, you will lose. Take it from me. So you have to identify what works best for you, whether you are good as an intraday trader, a positional trader, or a long-term trend follower. Okay, you need to devise strategies for which you need to do backtesting. Now, what has worked in the past, there is no guarantee it's going to work in the future. Okay, because markets are random in nature. And it's all about probability. So there is a high possibility that this thing may work going forward in the future.
Sure.
Yeah. And the most important, the holy grail of trading is you have to know how much you have to bet on each trade, which is all about risk management. That's where maximum number of people lose money.
Yeah, we'll get into that into the second part. It reminds me of August 2013, right? When the entire taper tantrum was happening.
Yes.
And I was very confident that the market is going to fall, and guess what? It actually fell. So I shorted. Okay. I shorted the market, and that day I made a spectacular 30,000 rupees. And I was like, boss, that's it. I've cracked it. Matlab, this is a new guy in town. And next day when the market fell again, I said, abhi dekho boss, ye to turnaround hoega, because every time intraday recovery aata hai lunch ke time pe, and I went long. And the market fell.
Lost more than 30,000.
I lost money. I lost more than 30,000, and that's it. That was the end. Okay. So anyway, folks. So your takeaways out here is that trading is fundamentally different from investing. The instruments are different. We spoke about futures. We spoke about calls. We spoke about options. what you need is also fundamentally different. You need a broking account. Now, you might want to just listen to my podcast episodes with Nitin Kamath of Zerodha back in April 2018, where we spoke about this entire thing. Nitin, in fact, is the head of Zerodha, which is among the which is a discount brokerage, and you can have there's an entire 3 episodes out there of how to do that, margin requirements, opening a broker account, how to choose a good broker, stuff like that. And then, of course, you need to have a definite strategy. Okay, before that, 2 things. One, you need to read up and know what exactly you are getting into. Okay, so please read up on all concepts of derivatives, all concepts of margins, all concepts of expiries, and all of this stuff. And this is very easily available on the internet, on YouTube, and a lot of other places. If you don't know, reach out to me, reach out to Kirit on Twitter, and we'll be more than happy to help you. And finally, you need to have a strategy. And that's what's coming up in part 2 of our F&O trading special with Kirit Manral. So stay tuned for that.
No material on the show should be considered as financial advice. The material on the show is for informational purposes only. Please consult a financial advisor before taking any investment decision.
Look! Up in the internet! It's a meme! No! It's a cat video! No! It's the Geek Fruit Podcast.
That's right. We interrupt this riveting broadcast to tell you about our show, the Geek Fruit Podcast, where Tejas, Dinkar, and I, Jishnu, talk about everything in pop culture, including DC, Marvel, Star Wars, Netflix, and everything in between.
You know how your friends hate it when you ramble about some nerdy crap and you just want somebody to listen to you? Well, sorry, there's nothing we can do about that, but come listen to us ramble and it'll almost be like the real thing. Kind of.
Listen to new episodes of the Geek Fruit Podcast every Monday and the Geek Fruit Bulletin every Thursday on iTunes, Google Podcasts, the IVM app, or wherever you listen to podcasts. Happy listening, you nerds.
Did you know that Parsis in Mumbai, instead of being left at the Tower of Silence after they die, are now cremated? And why? Because a cow fell sick in the early 1990s. Did you know that the smog in Delhi is caused by something that farmers in Punjab do and that there's no way to stop them? Did you know that there wasn't one gas tragedy in Bhopal, but 3? One of them was seen, but 2 were unseen. Did you know that many well-intentioned government policies hurt the people they're supposed to help? Why was demonetization a bad idea? How should GST have been implemented? Why are all our politicians so corrupt when not all of them are bad people? I'm Amit Verma, and in my weekly podcast, The Seen and the Unseen, I take a shot at answering all these questions and many more. I aim to go beyond the seen and show you the unseen effects of public policy and private action. I speak to experts on economics, political philosophy, cognitive neuroscience, and constitutional law so that the insights can blow not only my mind, but also yours. The Seen and the Unseen releases every Monday. So do check out the archives and follow the show at seenunseen.in. You can also subscribe to The Seen and the Unseen on whatever podcast app you happen to prefer.